We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Vince Lanci, Professor of MBA Finance at UConn, Commodity Portfolio Manager, and Publisher of the Goldfix Substack. Vince, thanks for joining me today. How are you?
Good. Thanks for having me on, Tom. And you forgot, all around nice guy,
Well, I'm actually that's the next thing that I want to address separately.
We'll
Vince,
take care of that in the edit.
we can, but this will get left in because I wanted to start this interview by expressing a little bit of gratitude to you because, when we have something like we're going to talk about today, I can send you a quick message and say, hey, this is something that I would like to do a show on. Do you have time for me? And you always make time for me. And I'm always very grateful for that.
Well, that's it's easy to do. You're a great interview. It's a pleasure. Great interviewer. It's a pleasure to be here. I will have you actually on, I think, and interview you with my guys for fun. I appreciate coming on here. You're well prepared and I'm still happy that you still call me now that you have all the rock stars, that you get, ambassadors and Judy Shelton, just happy to be here. So thank you for having me.
Well, it's always a pleasure because you spend so much time in the weeds of this. Your Goldfix Substack is so thorough and puts out so much material that I think it's just an excellent resource. But as you're going through all of this, what I wanted to cover today is this shorting situation that's developed, not only in gold, but also it now seems to have moved more so into silver. So what I really wanted to focus on today is, let's say, the short positions in the PSLV and SLV, what this means and why this is such an important situation. So why don't we start by just explaining a little bit about what this is and why it's important.
Yeah. All right. So before we get into this, because I will start, this is speculation and conjecture. It's informed from a person, myself, who trades these things and who was victimized by them and who drilled down to figure out it never happened again. But this new manifestation of it, it just rang a bell for me. And I went, oh, wait a minute, I've seen that before. So where should I start? We're talking about, I guess SLV is probably the easiest one to talk about. So I'm not accusing any bank of anything wrongdoing. There's almost certainly nothing illegal going on here. No, I mean, you're laughing and I'm laughing on the inside.
I like how you put that. There is just a little bit of room for something possible, but I like that we're not being overly sensational about this. It's like, that's why I come to you, because it's hard facts of what we can, 90% of what we can infer and actually prove.
Right. And this is sensational enough. And here's the thing. I'm telling you it's true. I'm betting my money on it that it's true. I've been in the markets doing this. And so for me, it's true. I don't need it to be proven in a court of law. That's what the concept of portfolio management is. And, there was I mentioned this a long time ago, but I want to mention it again. There were several cases about manipulation over the years. And I was in on background on one of the more important ones, informing them on the mechanics, the forensic aspect of how to tell if they're spoofing or not. So I'm pretty familiar with it. But again, enough with the personal pronouns. So PSLV and SLV. All right. So it starts with, without going into the weeds too much, gold and silver are precious metals that are neither destroyed or, they exist. They can't be destroyed. They're not consumed. And because of that, they lend themselves to carry trades. And so banks, knowing, let's use gold. Gold's easy to do, and it'll give you an idea of why silver is really become a problem for them. Because gold is not destroyed, because it's not used for anything, because investment gold is what it is. It sits there. It's a pet rock. Okay, that makes it a perfect store of value. Because of these things and the rules governing them by the government, it's become very easy to do carry trades on them. So they'll short the gold, take the money, and go out and buy 9% bonds somewhere, right? Or they'll and then if someone ever takes delivery in the past, they'd be like, oh, someone took delivery, which is like 1 in 100. Mm-hmm. They would then borrow someone else's gold because it was just sitting there. And so they would, I'll lease it from you for a month. I'll make delivery of this guy, this idiot who wants his gold, and then I'll get production when it comes online from mine, or something else will happen. So it's always there. It's always gettable. It's money. Can you get money? Yes. At the right price, you can get money. What interest rate do you need? So gold is money, right? So and because central banks do have a lot of it sitting around, and more now, but that's a different story. So the bullion banks who do these bank carry trades, they rely on the central banks who have metal sitting around. They can always borrow money from their rich uncle, whether it be a central bank or the Bank of International Settlements, which is really kind of the hub of the central banks in this gold thing. And so 99% of the time, it's not a problem. Even over the last 2 years, it's like China keeps buying gold. We'll find someone else's gold to borrow. It's a musical chairs game, I've referred to it as. When the music stops and somebody wants delivery, that's when the music stops. You have to find some gold somewhere. And so you're borrowing gold. And so lease rates go up a little bit and gold starts to creep higher. And we have what we had from, say, February of 22 to now. It was before then, but that's it. All right, so it becomes a crowded trade because there are possibly multiple claims on the same gold. Now, I have no proof of that, but certainly if I were a banker who had a hard time getting gold available to make a deadline, well, the expression is when a person has their balls in a vice grip, you will do what you have to do to remove that stress. And when you see a situation where certain bullion banks, multiple bullion banks, have access to multiple vaults, so whether we'll use a GLD. Obviously, I'm talking about JP Morgan being in a situation where I'm not saying it's JP Morgan. You have GLD, you have a vault for yourself, you have a vault in the LBMA, and you have access to all this gold in central banks. Well, it becomes kind of like not a shell game. It ends up being a shell game, but it becomes kind of like you're moving chairs around to satisfy demand. So you've got 5 chairs and 5 people who can ask for the metal back. One does. You just borrow from one and wait for the mining stuff to come on, and you fill that. You're robbing from Peter to pay Paul. Over the years, that trade has gotten bigger and bigger and bigger, and it's part of the problem that we're seeing right now with the repatriation of gold. All of a sudden, the U.S., on top of the China demand, right, wants its gold back, and they're also buying more. And in doing that, you're saying, oh, this gold that I had under lease that I was borrowing from Peter to pay Paul, it's no longer available. I can't get it anymore. And so now they're scrambling, and so you're seeing problems. You're seeing them call the Bank of England. You're seeing the BIS. Hey, can you give us some gold to lend? And that's what goes on, to the point where there's a picture. It's almost famous. There's a picture. I think Zero Hedge actually put this out there first. There's a picture of in New York of JP Morgan's gold vault and how it's very close to the Fed's gold vault. And that could be a coincidence, right? But what's not a coincidence is that there's a tunnel going from one to the other. Okay, so the tunnel from one to the other is predicated on the concept that, hey, we're going to do an audit in JPM's vault. Well, let's open the door and take some of the gold and bring it over here. And look, we've got all the gold. It's like we don't need it anymore. Bring it back. So it's kind of like
they just changed the green screen background.
Yeah. Schrodinger's gold. It's here.
Yeah,
it's not. As long as we don't measure at the same time, it's like a physics lesson. As long as we don't measure them at the same time, it's okay. And so the justification, this is the arrogance of it, okay? The justification for that is nobody wants the gold. Nobody uses it. We can just do that all the time. And they did do that all the time. Okay, let's assume that they're still doing it and they're struggling with it. Now you look at silver. Now we're getting into your PSLV ETF thing. Silver isn't stored by central banks anymore, at least not Western ones. So you start playing the gold game with silver, and you're dependent on two things, right? Central banks aren't coughing it up for you; they have none to lease you. You're looking for it from people who buy coins in silver squeeze and then sell them a year later, and then you melt it down and you make coins out of it, or legitimate scrap. And we're not high enough for scrap and mined silver, which we're in a shortfall. And so you're constantly asking people to lease your silver. Who's got a lot of silver? Let's say it's Bill Gates. Let me borrow your silver for 6 months. And little by little, you have a legitimate short squeeze brewing. That's what a short squeeze is. There's no asset available to satisfy the demand. So you're short and you can't borrow it anymore. Your shares become hard to borrow. So without the central banks backstopping, and this is something that Eric Young and I talked about several times, but he used the word backstop. Like, yeah, that's a good word. The central banks ultimately will backstop gold. The central banks are not in a position to backstop silver because they don't have ready available supply. So if you're a bullion bank and you're in a pinch and your metaphoric, testes are being squeezed again, you need to find another source. So who is that? Well, in 2011, it was SLV. In 2011, banks, now I didn't write about this, but I traded during it. And someone of renowned writing who writes for the FT, I will not say her name right now, wrote a very nice in-depth plumber's piece on it after. And I made some money. And I'm like, why did I make money? Why did I make so much money on this? It's really weird, And at the time, I was looking at SLV. And this is where the PSLV thing's going. SLV was getting shorted. And I'm like, oh, somebody who's smart is shorting it. Maybe we're going to come off. And I would use it to cover my shorts, my longs. But it turns out that wasn't the case. So in this article that was printed out years later, that I still have a copy of, it basically said this, and it laid it out. So I'm going to lay this out as if it's fact, okay? And I would say that this is very well-informed conjecture, and I can confirm it. But I want you to assume it's fact. If you read the documents, you'll know it. Whenever an ETF creates a share, basically a closed-end fund, that's what SLV is, the ETF has to buy silver. They have to get silver. And so if I'm the custodian of the ETF, right, they have to acquire silver. And so I basically have an accounting level. I have my vault that's here, and they have their vault that's there, and I don't literally move it over there. I just change the entry. This is for them now, and that's it. The accounting keeps it honest. And so conversely, if I sell my long ETF out, the SLV contract no longer needs the silver, and so it gives it back, right? Okay, so what if you short SLV? If you short SLV, then you can get the metal out yourself. Now, I'm not saying you or I could, but if you're a custodian, you can. So if you short SLV, which is what happened, so they had a little bit of a squeeze, and SLV back then became the central bank. They borrowed SLV metal by shorting by shorting the ETF and taking the metal to make deliveries somewhere else. So they were borrowing money from somewhere else. And eventually, in an efficient market, the shorting rate will match the lease rate of the physical. So it costs 7% to lease silver for a year. It should cost that much to short the shares. It doesn't happen like that all the time, but in an efficient market, which silver is not, it will happen. So here we are, 14 years later, and this is all in my head. It's all processed, and I'm just surfing on X or Twitter, whatever we're calling it now. And there's a guy, Semper Vigilante, and he's a funny guy, and he's always making jokes about the silver that is out there is existing in two vaults. He does Venn diagrams. There's the SLV silver, and he'll attack JP Morgan. So there's a JP Morgan silver, and in the Venn diagram is the common silver. And I'll put a picture of the King of Queens in there with one of those smirks on his face, and it's hilarious. And I'm like, yeah, I know about it, but that's known about. That doesn't happen anymore. And then boom, one day he puts up the PSLV chart. And I think you have that. You mentioned it to me, right? Because he puts up a PSLV chart overlapped with SLV. And he does some really cool charts. And I see this chart and I go, oh shit. And he's looking at it from multiple angles. He's saying, okay, maybe they're shorting PSLV to take the metal and deliver it somewhere. Maybe they're shorting it for some reason we just don't know. And then he has other charts that you don't have that showing how the algorithm is behaving. And I'm like, yeah, I understand. The kid, he's a man and he's got a business. He understands these things, even though he's not like, he may as well have been a fund manager. Anyway, so enough about how great he is. We all know I love him. All right, so I look at this chart and I go, wait a minute. PSLV's up there, but SLV's down there. Why is that? And in fact, SLV is going down while PSLV is going up. So I offer an explanation. And he goes, oh, that makes sense. And the explanation was, if there's a physical shortage of available silver that needs to be delivered to the US right now, which is straining the LBMA, which is making it hard for people who have to make delivery of silver to find it, and there is no central bank who's going to lend it to you, you've got to find someone else. Why are they not borrowing from SLV? Was my first question. Well, we don't know the answer to that, but let's assume that it's been borrowed enough. Let's assume that they can't do anymore. And let's assume that they're actually looking to replenish SLV. You robbed Peter to pay Paul, and now you're robbing Mary to reimburse Peter. Okay, so who's Mary? Mary is PSLV. PSLV has this massive shorting position of someone who's nakedly shorting PSLV, and I'm like, oh, they're taking the metal and putting SLV, which may or may not be true. But I'll tell you what is true. This is a fact. If you short it naked, they don't have to acquire silver. So you're trying to acquire all the silver in the world for whatever reason, for delivery on COMEX, and you have this little guy out there, relatively speaking, PSLV, who keeps buying silver every day because it goes up and people buy shares. And you're like, well, we can't have that. So you short PSLV. And if you short PSLV, you balance the demand. So you make sure that PSLV doesn't compete for the silver supply. We're into my opinion now.
Yeah. So this is kind of the mechanism that ends up affecting the actual physical market, the physical silver.
Yes.
That takes away, in essence, that vehicle of PSLV vacuuming, or the demand that PSLV actually has for physical silver.
Right, exactly. That's it, right? And I'm glad you said that. Otherwise, I would have gone down a rabbit hole. So I take this and I say, well, he's looking at his chart right there. Just to give an explanation, his chart is looking at the notional, right? It's basically volume, dollar volume, and PSLV is a smaller contract than SLV, and PSLV is trading bigger, and the scale is crazy. So I took the charts and I recombined them a different way. I think you have those charts. What I did was I put events, all this stuff that I just been babbling, that chart. I put events, that's the SLV chart, and it shows when there are big spikes in shorting SLV, what events were going on. So in COVID, you had a big spike. Someone shorted SLV, not because they were bearish, they could have been doing an arbitrage, but they're not. They were shorting SLV to get the physical silver to make delivery somewhere else. Silver squeeze in 2021, same thing. Russia-Ukraine war, they weren't shorting because they were bearish. They were shorting because they needed the metal, right? India, 2022, 23, China, 24 in the beginning. And I looked at that and I went, yeah, this makes sense. And so I went, why is no one shorting SLV now, as you can see on the chart, under my little logo there? And that's because they were shorting PSLV. And so I recombined them in a different way. And the combination, this way, the blue doesn't show up as well, perhaps. But I took the same time frame And instead of combining them the way Semper did, which was dollar value, I did it as a percentage of their average shorts. So as a percentage of its average shorts starting, so basically between 2019 when this starts and now, SLV has 561% of increased shorts, which sounds big, but it's not. It's the evolution of a market that's rallying, right? And then you look at PSLV and it's, I can't even see, is it 11,700 or 13,700?
13.
It's almost 14,000 what it was in 2019, and it existed in 2019. And then it's even more crazy when you look at the steepness. It was under 500 6 months ago. It was under PSLV 6 months ago, under SLV 6 months ago, and then it just ramped up. So who would short PSLV in that volume? Well, you can. Oh, we're shorting it because there's an art. No, you're not. That's bullshit. You're not doing that. You're shorting it to get the metal, and you're getting the metal, and you're delivering it either on COMEX or you're restoring shorts that you had on SLV, because SLV was not getting shorted during that time. And so what you've done, so I take this whole complicated package, right, in my bizarre way of explaining it, and I text it to my buddy who's a real estate executive, and he's also a silver person. And I go, what would you call that? He said, what would you call that in your business? And I explained it, and he goes, I'd call that insolvency. And I thought he was being wise. He gets wise with me a lot. But I'm like, what do you mean insolvency? He goes, well, and this is the key phrase, because he's thinking about it from a real estate person. He said, the bank that's shorting PSLV in order to get metal is monetizing something they do not have, right? So I'm going to sell you this pen. Well, if we can't do the pen, right? Here, I'll sell you these gold coins, right? I just got a delivery, right? I'll sell you these 13 gold American Eagles, right? But I don't have them. So I'm going to sell them to you and I'll give them to you in like fucking 6 months. That's monetizing something.
Don't worry though,
that's
your
profit.
name's on them.
It's a promise, right? Exactly. But that's the point. Like he said, they're monetizing an asset they don't have. And I went, oh shit, they're not a silver bank. They're a financial bank that's shorting silver to get money to do something else. And it reminds me of something that Alistair, I'm probably saying his name, Alistair McLeod said, when he was talking about the banks in England. He's calling them zombie banks, would be the American equivalent. He said they're not fit for purpose. So you have a bullion bank who doesn't have any bullion, who's borrowing bullion from a non-bullion bank. They're insolvent. That's what that is. That's insolvency. Unfortunately, they'll get it back over time. But that's the long version of it. But
so to kind of sum it up, this
please do that. Please do that.
And the way that this metal, quote unquote, changes hands under normal circumstances isn't an issue, right? It doesn't become an issue. We can, put that guy's tag on it and we'll get the metal next week or next month, whatever it is. The production comes in under normal circumstances. But under these circumstances, and we'll get to what the catalyst may or may not have been for this, with this massive spike in actual physical demand and physical deliveries, we've come to a situation where every vault has their runners. We can think of it like that, or their keyboard guys. Every single vault is trying to frantically swap different tags and put everybody's name on the same gold and silver to be able to actually show that it's there and or not there, kind of thing. To as you said, this in a way shell game that gets played. This is coming to a head because of the actual volume that is being demanded right now.
Right. And that's right because too many people want it at the same time, and that's a problem. So we've got to take people out. PSLV, we don't want them buying it. So I'm going to show again. This is my opinion, but I'm right. That's basically it. PSLV, they're buyers. We want to get rid of competing buyers. We're looking for silver in the couch cushions. We're looking for it everywhere. Who is this guy? But get him out of the market. Legitimately and legally. But you're abusing a mechanism that's meant for emergencies, and that's where we are. Yeah,
Vince, do you think there should be a limit to this type of naked shorting like this? Because you hear this in regards to all of these different, let's say the TSX in particular, this
right.
Naked shorting issue. Do you think that there should be a limit to this?
Yeah, but I mean, yes, there should be, but I would have to. We didn't discuss this question. It's a good question because I can't answer. Good questions are the ones I can't answer. The answer is yes, but I struggle to figure out how to do it because my libertarian side says there shouldn't be a limit, but my orderly market side and protection of investors says there should be. That's a good one. How would you limit it? Well, it's probably pretty easy, and I'm probably just overthinking it, which is not uncommon. You would want to limit the discretion that banks have. And that's the obvious thing to say. But the reality of it is they're permitted to operate in multiple venues with their discretion. And because of that, regulatory boundaries are blurred for them. And because of that, they get to abuse it. The answer to your question is yes, it needs to be limited. How would it be limited? It would be limited probably the same way they limited when Man Financial went under, or EDF Man. They're mixing custodial money with proprietary money, and so they can get away with that in the assets and silver because no one checks on it. I think the market's small enough that nobody cares. That's really what it is. Mm-hmm. It's not big enough for them to care. But I think it should happen. It would drive prices higher. Now, in fairness to my libertarian side, it is happening slowly now, okay, which doesn't help the guy who's got, 10,000 ounces of silver, sitting in his basement for 20 years, and he's on a life support right now. It's unfair to him because the markets are not being efficient. They are going to reach the price they have to reach, but not in a time that's appropriate. Look, the silver situation is a nickel situation. It's really that simple, right? The silver situation is the nickel situation. For those who don't remember, the LME had a nickel crisis. They had a big short in the market. It might have been a customer of JP Morgan that was short. Surprise. I'm not sure. I could be wrong. And that customer blew up and just said, I'm not going to cover. And so they had to buy metal somewhere else. You're seeing that now in silver in slow motion. And you can make the case, I'm speaking as if I'm an advocate for the people that are short, to say it's legal, we did it, the market is now a little bit disorderly, but nobody really got hurt, as opposed to the LME. Really what it is they have franchises where they make a lot of money and no one knows about it, and they don't want to lose that franchise. What did they pay? $1 billion in fines?
Cost of doing
back in
business
the day?
for that year.
Right. They made about, $20 billion, and that was, 20 years afterwards. Anyway. So
does Vince, does this also extend to the lease rates? This basically explosion in the shorting side of things. Does this also extend to the lease rates?
You mean we're talking about both metals, or are you sticking with one?
Let's stick with silver for now.
Okay. So silver lease rates went from virtually nothing to 7% officially, probably as high as 8.5%, maybe close to 9%, depending on who you talk to. And those rates were an example of the short squeeze happening. Okay, so it's like I'm short silver. I've got somebody, wait, they're taking delivery? Who is it? China? Who is it? The US? Everyone's taking delivery now for whatever reason. Could be tariff based, could be, some solar panel thing that we're putting up. Who knows? But we want the silver, we need the silver. And so the bank is like, oh shit, I got to make delivery of it. And so they go to lease it. And but they have a limited source. And so the lease rates go up and up and up. Until you get to a point where everyone says, I'm not going to lease it anymore. Or they say, I'll lease it to you for 30 days. Or they say, I'll lease it to you for a year at 40%. Now, that number I'm saying there, that's what Warren Buffett did to the market. In 1997, Warren Buffett took delivery all at once. And the bullion banks were not ready for it. Now, they didn't get hurt. The miners got hurt. And Buffett's like, I want all the silver. And they're like, we don't have it. We have to lease it. Well, the lease rates were through the roof. And so Buffett said, you know what? I won't take delivery of the silver. I'll delay it by a year. And what will you allow me to lease my silver back to you so you can give it to me a year from now? And that was a 40% lease rate. So the lease rates are the second thing to move. The lease rate moves and then the price moves. So right now we're at the lease rates are high and fluctuating, and the EFP, which you and I talked about before, that's an indication of a problem. So the lease rates are discounting the problem, and I think even when they come off, they're going to remain elevated, showing that because of supply chain problems, because of mistrust, because of a lack of collateral, because of the BRICS behavior over the last 2 years, there's just not enough silver to satisfy at the current price.
So going back to, let's say, the difference between silver and gold, is this different in silver because of the actual logistics involved?
By logistics, you mean the London to New York logistics?
Yeah.
Okay. Well, they're actually remarkably similar in that respect, right?
And they're not different because they're not different because of the actual bulk, just the bulk volume of metal that has to be moved. Let's say,
no, they're very
equivalent
different because of that.
Monetary amount of silver versus gold.
Touche. Yes, you're right. They are different in that respect. But I was going to get to why they're different. But why they're the same is, the metal's there and we need to have it here. Right. Mm-hmm. So let's pretend that right. So it has to be transferred. In the past, you didn't transfer. You just said, okay, accounting change. If you need it, I'll bring it to you. No one ever needed it.
I'll get it to you.
I'll get it to you. Yeah. I'll get it to you. The check is in the mail. That type of stuff. I'm good for it. Yeah, exactly. And then eventually it comes back, or they find metal locally and they say, oh, would you take this metal instead? Mm-hmm. It's all the same metal. Now we get into your point about the difference in metal. And that's actually a very important part, and it played a big part in the Chinese problem. So before I touch on the Chinese thing, if you want $1 billion of gold shipped from England to the US, that's, a plane load. If you want $1 billion of silver shipped, that's 90 plane loads. Yeah. So right. So logistically, to your point, physically speaking, it's a problem. Absolutely. It's a big problem because nobody ever wants their silver locally. And in fact, you bring up a good point. During in 24, the beginning of 24, the Chinese premium to the US was very elevated, like $3, maybe $4, maybe $5 at one point. And I had reported back then in actually November of 23, it was a report, no one talked about it, but it was true, and I confirmed it, that a bank, an American bank, who shall remain nameless, took delivery of gold and literally shipped it to China. And the sales pitch was, they're closing the arb. Gold was trading, let's say, $5 premium in gold, which is nothing, right? All right. But silver was trading at $5 premium. And so people started saying to me, well, when's the silver arbitrage going to happen? And I kept saying, to your point, it won't. It won't.
Just too expensive and too bulky to move.
Right. Exactly. I want to make $5 an ounce on gold. That's one plane. I want to make $5 an ounce on silver. That's 50 planes.
It's going to cost you 10 times as much.
Yeah, exactly. And so if you actually start to do that, in fact, that's why China started increasing their uptake of concentrate from Latin America. Another conversation. But yeah, so it's physically too hard to do. And so you have a bigger problem here, because even if you do have the metal to ship it there, it's not something you can do overnight. What the LBMA said, it's really heavy. I think that was their excuse. It's really heavy. That's what happens when you
the
don't
hallways are small as well.
Did they say that?
It was something to that effect. Like,
oh, that's great.
There was like something to the effect of, there's gold in the hallways because we're doing X or Y, whether that was like a renovation or an audit or something like that. And It's just hard to logistically move around right now.
Yeah. I mean,
which we don't take the time normally to consider those things of like, oh, I want gold. Well, how does $1 billion worth of gold actually move, right? Like,
that's right. Back in the 90s when Warren Buffett was doing his thing, I would watch the vaults, and it was no one was watching except a couple guys in the physical side and me. It wasn't really, you couldn't get it online. It was hard to get, and I would be, I was like a student, and there was an old guy, and I was like, oh, look at that, 30 million ounces came out of silver. Was taken out of silver, and I would run over to the guy. And I'm like, look, 30 million ounces. He goes, and he would say, you ever try and move 30 million ounces of silver? I'm like, no. He goes, they can only take out 3 million ounces a day. And he's like, this is what they do. They take it out of this in the U.S. They take it out. They put it on the whatever you want to call it, the ramp that goes up, the elevator. It goes up. They put it in 1 billion trucks, and it's gone. He goes, 3 million ounces in an 8-hour day. That's how hard it is to do because of the limitations of the physical structure and logistics. I go, well, where this is me. Where? So he goes, oh, they just threw a sheet over it.
Yeah.
Like, that's our silver. This metaphor, he's like, we declare it ours, we're not going to remove it. And that was Philip Brothers playing their games back then. But that's the point,
And that's barring that video. I don't know if you've ever seen it, of the guy driving the pallet jack right off the loading dock and getting thrown up and over the actual thing and landing on his face.
No, I've never seen that. That sounds funny. Wait.
Well, it looks really painful because he gets thrown like 20 feet and just lands like flat on his face.
Oh, so the weight pulled him up and he threw him over?
Yeah, like he didn't let go of the cart and went the cart went over the edge and he got like just catapulted up and over the cart.
And Tom, that's the LBMA's point. It's a very highly skilled, difficult thing to do. And I believe they just made an announcement that they're training people. Like, you're training people, like you're training people.
Well, to be fair, they're not used to having to move more than, let's say, 1 or 2 pallets a day, let's say, right? So if you think about that, like, that's a legitimate reason for things being delayed. When all of a sudden you don't have staff to actually move all of this stuff, or the guy the guy that you've had for 40 years that was doing it is old and decrepit and can't keep up the pace anymore. Right.
It's like a union, right? No, but I agree with you, and I'm going to say but because I don't want your people going like, oh, Tom says it's okay over there typing right now, and I'm going to balance that out for you. The balance is this. TD's what's his name? Ghali, Ghali. I'm not trying to say his name. He made a comment, and he was talking about something called microstructure, which is really the finer point of logistics. And this is what he said, and I agree with him. And your point also does into this. He said they're calling it logistics. If it's logistics, to your point, then things will just slow down. Okay, we don't have enough people. They're heavy. The hallways are small. Fine. Those are all legitimate logistics reasons. You're not used to this kind of volume. You'll get to it. We'll delay it by a week. We're swamped. Everybody wants a Cabbage Patch doll. You're going to have to wait a week. I'm sorry. I'm dating myself, right? Okay. But what he said, I think his first name was Ben. Ben. So he said, the problem is microstructure. And I'm like, what's microstructure? It's a fancy word, right? He goes, well, it's not just the fact that they only have a 90-year-old decrepit man who's on the job, which is probably true, right? They also have leases that are coming due, going into the pipeline for delivery that are not available anymore. So an example would be, I say, I want your silver, and the pipeline starts to pull the silver, right? But meanwhile, the silver is off lease and it's not available, or it's on lease. And so the pipeline, it's very natural gas oriented, at least in my mind. The pipeline starts getting air bubbles in it. That's your microstructure. So it's like, okay, we got that one. Where's number 3? It's like 1, 2, 4, 6, 9. Where are these? They're not coming in. And your 90-year-old guy can't even move them because they're not there. So the point is, logistics is business, and that's why you add a couple days or a week. But not having the silver at all is a microstructure problem, and that's what they're going through right now. Because there are too many. I would bet there are double and triple claims on silver in England right now. Mm-hmm. That's unfortunate.
So Vince, let's wrap this up. Let's summarize this entire situation. Is the silver squeeze a process and not an actual event?
Yeah. You're using my my phrase against me. Yeah, for the longest time I said gold is a process, not an event.
Gold research.
And I still have that on my posts. I totally get that, and it's true. I mean, it's still true. But I think the world is aware of the gold process now. I think we see it. Everyone's admitting to it, except for a couple banks. Silver, I think, is our new process. I think you're right. I think the silver squeeze. How about this? The silver squeeze is a process, not an event. That's really the truth of it. The truth of it is they don't want headlines. That's why I said the gold is a process, not an event. They don't want headlines. They know it's got to go up in price. They know the market has to reach an equilibrium at a higher price, but they don't want it to happen overnight because you will take a bank down. I don't know what bank, but you will take a bank down. You will have headlines. So I would say that, the silver squeeze is a process. It won't be an event. There'll be hiccups like we saw in 2021. But yeah, I think that's a great use of a phrase that I said before for silver. The silver squeeze is a process. It's not an event. And by the way, if we have an event, that's great. I bought a monster box today too. So that's great too. But if we don't, I'm okay with that. That's basically it.
So Vince, we were going to cover as well what the catalyst for this physical demand was. So do you think that this is tariff driven?
Do I think it's what? I didn't hear you.
Tariff driven.
Oh, yeah. I think tariffs are the new thing, compounding an existing problem. If you don't mind, I'll get into that. Okay, so if you just zoom out a little bit, right? We're focusing on gold here. Silver is a little different animal and actually worse because of the tariffs. But the whole thing, the reason that gold and silver on its way are where they are is they've benefited from a confluence of factors. Nice word, right? Not my word, but I borrowed it. All right, so it starts with trust, right? The world stops trusting each other, and so they start de-dollarizing. Boom, 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 boom. And tariffs are key here. Tariffs are a logical step, but one that I think surprised some people. The world starts de-dollarizing. They sell treasuries. They buy gold with it. Now, you and I and people listening to this are like, yeah, we know that. Yeah. But a year ago, you didn't know that. 2 years ago, nobody knew that. Like that. This is like accepted in our community. Meanwhile, the rest of the world still is figuring out what's going on. But anyway, so Trump comes along and he recognizes two problems we have, or Scott Bessent does. He says we have to reduce spending because one of the reasons they started to de-dollarize was trust. And the other reason was the economics of it. The U.S. has too much debt, right? And so Trump says, I'm going to work on the debt, Doge and all these other things that he's working on. And one of the things he's working on is tariffs. So in order to change the American economic structure, one of the tools that he's using is tariffs, which will curtail purchases of foreign goods, encourage domestic use of manufacturing, and offset some of the shortfall that he has in the deficit. It's actually a good idea. The problem is the rest of the world went from, we don't trust you because of what you did to Russia, to, shit, if you're going to tariff us, we're not going to have the money to buy your treasuries. We're not going to buy your treasuries because we don't want the dollars. We don't want the dollar legacy. We're going to buy even more gold. I guess it would have to look like this. The tariff makes a foreign country look at the U.S., depending on who they are, and say, is this America first or America alone? Because if it's America alone, I don't want your treasuries. So they're de-dollarizing faster, right? So overseas, tariffs make you buy gold for so many reasons. I'm buying gold because stagflation is due. I'm buying gold because I'm not going to be spending my money. I may as well put it in a store of value. That's the economic reason. All right, I'm not going to be selling my goods anymore to the U.S. Now I'm buying gold because, well, shit, I'm not going to buy treasuries if it's not America first, it's America alone. It's an isolationist behavior. Now, I'm not saying that we're being isolationist.
Especially once we start to get in this tit for tat thing of charging reciprocal tariffs as well.
That's right. Right. And so they're going to push back because it's political, right? Whether you agree with Trump or not, and I actually agree with him, our tariffs on world goods are too cheap. And if you want multipolarity and you want to trade in your own currencies, fine. Then you're not going to own as many dollars? Fine. Then you're going to pay the same price for our goods as we pay for yours. And he's doing that. And so, like you said, France is going, well, then we'll raise our tariffs on you. And so the whole thing just escalates higher until someone breaks economically. Fortunately, the U.S. won't be the one to break first. Mm-hmm. China won't break first either. Europe probably will. And they'll capitulate. And unfortunately, I had a conversation with Sean on his podcast, and I said back then, I'm sorry, what?
Sean Newman,
yeah.
Just to fill listeners in.
I'm sorry. So I had a conversation with him, and we were talking about the tariffs, and I said, it's not going to happen. Like, I wasn't adamant about it. I'm like, it's not going to happen. Trump's being a bully. He's doing stick, and then he'll do carrot later. And I still believe that. But my goodness, it's going on a lot longer. He backed off on all the tariffs. Don't get me wrong, but it's happening again. And small businessmen's confidence in Canada has cratered. So Canada is, really stressing about this. Anyway, the point is, if I'm a Canadian, I'm probably going to be buying a little more gold right now. I'm certainly not going to buy. So it's almost like he's pushing people. The cure for the economic part is to use tariffs, which makes people sell treasuries even faster or buy gold even faster. On top of that, we're just going, you know what? We want our gold back too. Well, holy shit. So everybody wants their gold for different reasons. I think we're going to release a product with gold in it at some point, whether it's a bond, like Judy Shelton says, or whether it's a stable coin, or whether, Trump just refurnishes his home with gold toilets. I don't know. But the gold's being brought back for a purpose. Tariffs are a cover. Yeah.
What does April 2nd mean for tariffs, Vince? And are the metals exempt from the tariffs or not?
Right. Well, for April 2nd is an important but not most important signpost for metals. However, most people don't really. My students didn't know about it, and probably just as well. But the April 2nd is when Trump intends to implement tariffs in 4 or 5 different buckets that are going to greatly affect trade. So he's going to pick an industry and he's going to tariff it. He's going to pick the country and tariff it. He's going to pick a universal for the world and tariff it. And there'll be retaliatory tariffs. So what that does is it's going to drive up in the United States. We met the United States, right? What that does is the moment the tariff goes into effect, to simplify it, everything that you buy goes up in price that you normally buy. So if you're a company that needs to buy copper, you're buying it now. The term they use is front loading. So you're basically getting it under the wire. The deadline is April 2nd, so buy all the copper you can. And that's happening with silver as well. And some people believe it's happening with gold. So to answer your question directly, gold, I believe monetary gold, or gold that's not a necklace, will not be subject to tariffs simply because it's money. I mean, they're not going to call it money, but it's monetary. All the other gold could be subject to tariffs, although I think there'll be carve-outs. Silver, well, silver is going to be subject to tariffs. And I say that because silver is in the same category as copper as far as the country is concerned. And people are buying copper hand over fist because they think these tariffs at April 2nd, and they won't be able to buy it for the same price anymore. But the tariffs in general are bullish for everything, meaning gold, silver, and copper. And when the tariffs hit, if they become chronic, you'll either get recession because the world will stop doing business because prices will be too high, or you'll get stagflation, which is what Powell is worried about. I believe, and this is my trading on this right now, I believe that whatever happens after the tariffs, gold remains firm because tariffs mean I'm just going to buy more gold because I don't want to buy treasuries, right? Mm-hmm. Tariffs increase the mistrust. With regards to silver, I don't know, but I do believe that the world price of silver will go up after the tariffs go into effect. So, for example, if the U.S. is a buyer of silver and whatever the tariff is, it makes the silver price go up by $1. Let's say a low number, right? Well, I believe the rest of the world's price of silver will go up by 50 cents. And so I believe that it won't just be a U.S. tariff, it will affect the world. And my evidence of that is if you look at the copper market, which is easier to observe the difference in price, the COMEX price of copper has exploded, relatively speaking, relative to the LME price. The price differential is pretty big. I have a chart to that effect if you want to show it at any point. And that means that you would think, well, the price of copper elsewhere is cheaper because everyone's just selling their copper to the U.S. idiots. It's not. LME copper price is going up too because they're having a hard time finding it. So there's a genuine shortage of copper out there that may be satisfied at some point, but probably not anytime relatively soon. Silver, which we never talk about, it will never be in a headline because it's really too important. I like to say, gold is money, but silver is more. It is. Silver is industrial, its demand is inelastic, and it's monetary. The price of gold goes high enough, silver will become pure money again. So in silver imports that are finished, let's assume there's a 25% tariff on silver coming into the market, into the U.S. The good that you buy with silver in it will be tariffed 25% higher. The raw silver on spot will go up by 5%. That's what I think. And that's from a Goldman Sachs report that I've extrapolated. So a 25% tariff on silver is a 5% price on silver finished goods, is a 5% increase in price at spot. So ultimately, April 2nd is a tariff deadline. And to the extent that those tariffs go into effect, it has been bullish for silver, gold, and copper. And to the extent that it stays in effect, it will be bullish for gold, sticky for silver, and probably bearish for copper in the long run. Hope that answers the question.
Vince, the last thing that I wanted to go over with you here is your coverage of banks' reports on gold and silver here. Right. You cover this quite a bit on your Goldfix Substack. So has the tune of many of these bank reports changed over the last year, 2 years towards gold, especially? Yeah.
Yes. In fact, the transition came in probably started coming in July of last year. And so part of my familiarity with bank reports from my years looking at these things is that I know how bullion banks operate with their marketing. So they have to, on one hand, satisfy their clients, and on the other hand, they have to satisfy their macro view. So if their macro view is the dollar is higher, they can't really be bullish gold. And so there's all the other shenanigans that go on as well. But coming back to the actual main point, the bullion banks had a model, and that's the same model that the mainstream media is using. That model is gold is denominated in dollars. If the dollar goes up, gold goes down. Gold is subject to the opportunity cost of interest rates. If interest rates go up, then people take their money out of gold and put it into something that bears interest, treasuries. And so that's been the governing rule, trading gold and silver to an extent, but we'll stay with gold on this one, forever, since probably 1993. That really kicked in hard. And so gold became a surrogate for the dollar. Gold wasn't itself anymore. Nobody wanted the gold. Right? There was no process going on. It's like, oh, gold, it's there, it's a brick. You got some gold. Okay, well, the dollar's up, I'll buy less. The dollar's down, I'll buy more. I'll sell it, I'll buy it, whatever. And it becomes like an arbitrage, like an FX. Like they made gold into a paper currency by doing that. That's really what they did. Okay, so along comes China and everyone else, but China most specifically. And then you have your events, and that's the Russian war, the Russian-Ukraine war. And all of a sudden they want the gold, and they want the gold while they're selling treasuries. So for the next probably year and a half, we were probably first or second to say this adamantly, and that was gold started ignoring the dollar, and everyone started saying, well, it'll come back. And you know what? It always comes back, right? But now it stopped coming back. And so what I noticed was the bank reports, all of them went from we're bullish gold because the dollar is going to weaken to the dollar is stronger and gold's going up. One bank would literally say in their institutional reports, we don't know, it's a mystery to us. Now, I think they knew, but that's what they had to hold out. Another bank said, while we're skeptical of gold's rally in the face of a stronger dollar, we're hesitant to sell it because we think something's going on. And all these banks had their little ways of saying, we don't know, but right, or we do know, but we can't say yet. Mm-hmm. And then all at once, it almost serially, it's almost like they had each other on speed dial. And they all started coming out with what they called new models, new ways to model gold. Now, I'm not throwing shade at them. I mean, I am all the time, but what they had to do was they're like, we can't recommend gold to, none of them recommended gold, okay? It's up $1,000 from 1,800 to 2,700 to 20, no, I'm sorry. Let's call it like when gold hit about 2,500. They're like, we have a new way to model gold. And I'm like, oh, really? What way is that? Well, we're going to look at the demand for gold coming out of central banks. I'm like, wow, what an idea that would be. I said to myself sarcastically, that's fascinating. They want the gold. They want the gold. And so the point is, this gold is being bought, and it was when the dollar is weaker, they bought it. When the dollar's up, they bought it. They didn't care. We don't care about the dollar anymore. We're getting out of our dollars. And so Goldman came out with a report saying, they started to quantify, and I just loved it. They're like, for every 1,000,000 ounces of gold, for every ton of gold that's bought, that's not going to come back on the market, we add this percent to the price of gold. Mm-hmm. It's beautiful. It's the way supply and demand works. And then Bank of America came out with their model. And their model was, we look at the physical demand coming out of China and focus specifically on the fact that the insurance companies are buying it now. And we know that they're going to buy 1% of their capital. And so yada, yada, yada. It's going to end up becoming 6.5% of physical gold demand. That adds $500 to the price. And all these banks started talking, when gold's around 2,500, of a new model. They all had their own way of saying the same thing. And that is they were quantifying the physicality of the gold. And all the banks now are positioned to recommend gold wholeheartedly. Are they sure? The whole CFTC thing, swap desk, are they sure? Yeah. Are they losing money on that? Yeah. But the demand is too big now, and they have to have it. And the demand is grassroots, and it's actually coming from their clients now. You got central banks buying it and nobody cares in the West, right? And then you got gold hitting 3,000 and now they're calling them up going, hey, how come you never told me to put money into gold? Well, we have this new model. Well, I want to buy some gold now. Let's buy an ETF, right? But you know what? Maybe I want to buy something else that's related to gold. And so the whole industry is being raised now. Miners are next.
Well, and that's exactly where I wanted to go with that. Are they actually moving some of their focus to actually understanding that this stuff does need to be dug out of the ground and trying to, bring some of their analysis into the mining sector?
Yeah. Okay, so I know a lot of people are miners people, so I'm going to spell it out. This is what the banks do. The banks have known all along that the miners were undervalued. Okay, the banks have the fundamentals down. They know what the cost of carry is. They have the sheets. Like, this is really cheap, all-in cost, AIC and AISM. Why are they not recommending them? Because they're salesmen and people wanted NVIDIA. And so they didn't pitch them. Now people want it. And in the past, they wouldn't make a big deal. People want it. So we'll let them have it, but we're not going to recommend it too much. But there's another phenomenon happen, and that phenomenon is the Mag 7. We'll use them as our lightning rod here. The Mag 7 is no longer doing well. And so when your client says, and my client, I don't mean retail, but I mean when your institutional pension fund says, you know what, I got too much exposure to NVIDIA, what should I buy? Mm-hmm. And he's an equity guy. You say, put some in an ETF. That's what Michael Hartnett said. Put some in gold, right, to his clients that are, billion-dollar pension managers. And they're like, gold's at $3,000 now. We like it, but we want something else. We'll just put it in bonds. No, you know what? We don't want bonds. They kind of suck too. What can we put it in? And so the new response, this is fresh. The banks like Bank of America and RBC are getting asked by their biggest institutional clients, tell us which miners track gold price best. Mm. So the most recent Bank of America report on miners says, all right, you asked about miners. You asked specifically which miners track gold best. Here they are. And they gave their list. And we shared that with premium subscribers. RBC, this is all this week. RBC, which had been, they're heavy mine cover. They're a mining bank, that's their business, right? But their last report was like, there's no flow into miners right now. This is what we got. We think the mining companies are really not doing a good job of addressing investor concerns. Right? They're running their companies fine, but they're not increasing their dividend. They're not buying their shares back. So we're going to put them in a holding pattern. 2 weeks later, you get RBC saying, here's our list of 100 miners ranked by spot gold performance. And I'm like, wow, that's great. I put that out yesterday. And so now in the last 5 days, we've gotten a report from Bank of America saying, you're interested in miners? Here's the ones. So they're not just putting people into it, they're throwing it out there. And I think what they're doing is, as salesmen, they recognize that NVIDIA is not hot anymore, to simplify it. And they want their clients to stay with them, so they're giving them gold exposure. So you got Bank of America, you got RBC, and then yesterday, I think it was on investing.com, I haven't seen this report, but JP Morgan, of all people, JP Morgan, the killer of the silver squeeze in 2021, says we like miners now. Now they're base metal miners, industrial metal miners, but they like miners now. So you got JP Morgan, Bank of America, and who else did I say? RBC, all big in gold, especially in the mining sector, saying buy miners because their clients want it. So I believe when you take the information that I'm giving you and the observations that I see and how bullion banks behave and how they get ahead of a trend, I can almost tell you with certainty that they're already buying. And I can almost tell you with certainty when you take these two things and you line them up with technicals, like by Jordan or Jordan Roburn, Daily Gold, and other people, that miners are now breaking out technically against special indicators like the SPX, like the QQQ, and I actually charted the GDX versus the Mag 7. I'll give you that chart to put up in a second, but the GDX, the Gold Miners Index, versus the Mag 7 since inception is flat. Mag 7 has come off so much since the 2014, I think it's 2014 or 2019 inception, that GDX is flat with it now. And so Mag 7 is on the way down and GDX is on the way up. And then on top of that, I'm saying this because I just bought more. On top of that, you're seeing that when stocks are getting slammed, miners are getting slammed less. And when stocks are going back up, I'm seeing miners almost keep pace, and in some days outperform. I believe that we are on the cusp. I'm not a mining expert, but I was a fundamental analyst. I believe that we're on the cusp of an incredible broadening of Western money going into stocks that are gold and silver based. And I'm short an ETF called AIS, which is basically an AISC. I'm short that, not AIS, I'm thinking all-in sustaining cost. I'm short AIC and I'm long GDX. So I've been playing this for a while and I haven't gotten hurt, and it's starting to work now. And if Powell eases rates and people start putting their money into equities again, well, they're probably going to be putting a bigger chunk into gold and silver miners. However many silver miners are left, that's what they're going to do.
Well, Vince, I think that kind of wraps everything up that I wanted to chat about with you. There's certainly so much to pay attention to. There's certainly so much that is changing right now, and I really appreciate how hard you work to keep everybody abreast of that.
And I appreciate your work as well. Thank you for having me on here. And I really, you're one of the best. I like coming on here and talking to you. And our conversations before are also interesting. And well, if you can have like a bonus way to record those and hear those without getting in trouble, that would be kind of cool too. That'll be kind of fun.
Well,
Anyway, thanks for having me.
maybe in an upcoming project that I'm working on, we can have that kind of discussion.
Yeah.
So
that'd be great. I'd be interested in hearing about that.
For anybody that's wanting to read more of Vince's work or see more of the charts or the reams of data that he comes out with and analysis, that's all available at vblgoldfix.com or the VBL Goldfix Substack, as well as excellent Twitter follow at Soren the K, SORENTHEK. Vince, thanks so much, as always.
Thank you so much.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.